Sylvia's Traders Lounge welcomes you to yet another webinar where we learn, trade, and profit. We shall be giving you trading insights on technical analysis, fundamental analysis, risk management, and trading psychology. Today's guest is Surjeet Zenawi, and our theme is how to apply wave analysis to find an edge in trading Forex.
Thank you for making the time, and we will start off. Today we are privileged to have two guests. So one is Razak and the other one is Surjeet. Our guests today are Surjeet Zenawi and Razak. Surjeet Zenawi is the Chief Market Analyst at Cherizon Waves, a global technical analysis and education provider, Kenyan born. From the age of 17, Surjeet took the unconventional route of learning the science behind what drives the Forex markets and the key to trading these assets profitably. In this quest, he discovered Elliott's principle, the Elliott Wave principle, combined with other techniques on major Forex pairs to identify and provide profitable trading opportunities. Surjeet has trained others internationally on how to use these principles effectively and heads the division for technical analysis at Cherizon Waves, which is headquartered in London. So maybe we can start off by Razak telling us briefly about Cherizon Waves and who he is and why he is here today, and then we can go to Surjeet.
Yes. Perfect. First of all, thank you for having me today, Sylvia and Gilbert. And to the audience, my name is Razak Oyebade. I'm speaking here from London, and my position is the Head of Business Development at Cherizon Waves. So as Sylvia briefly touched on, Cherizon Waves is a global technical analysis and Forex education firm. Our teaching specialize in the roots of combining modern-day Elliott Waves, designed by Ralph Nelson back in the 1980s, combined with Fibonacci and some other modern-day techniques. So a lot of our work focuses on giving analysis, trading opportunities, and technical analysis, as well as providing sort of education and mentorship in the realm of our work.
All right, and what does Cherizon Waves entail?
Yeah, so Cherizon Waves, as I mentioned, there's two main divisions of our business. So one of the divisions is analysis. We combined all of our sort of practices when I say that. So we have one swing trading PDF, which is 10 to 15 trading opportunities, which we essentially swing throughout the trading week, essentially giving the insights of what the same actions we're taking on our proprietary accounts. And we also have things like, intraday analysis for, the traders who are on the charts, as the opportunities unravel in the marketplace. So we're providing sort of different levels of analysis dependent on, what type of trader you are. And as I mentioned, we also have the education side. So for those who are learning how we conclude our trading opportunities, we provide them with the exact science on A to Z, giving them illustrations on what is Elliott Waves, how's Elliott Waves used, specifically in the Forex market, because I just mentioned the original, or should I say the sort of authentic usage of Elliott Waves was actually derived from the stock markets back in, as I mentioned, the 1980s. So us using Elliott Waves to identify profitable opportunities on Forex is, a thing in itself. So we break that down sort of pragmatically across a series of videos, tutorials, PDFs, in order for one's quest to learn how to do that effectively.
All right, so I understand you will be speaking on what you guys do at Cherizon Waves when we're also interviewing Surjeet. I'm glad he has been able to join in. So feel free to, engage with us during the webinar. So for Surjeet, welcome. Welcome. It's been nice to have you. We've done your bio already. And please talk to us about your trading journey, starting off as a teenager at age of 17, the markets you trade and what keeps you active in the markets, especially with the, with the recent increased volatility and also the uncertainty in the Forex markets.
So thank you, Sylvia, for having me. It's a pleasure. So I started trading in the year 2017. I was just like 18 years, 17, 18. So I started when I was in India. So I went to India to study. So I was doing petroleum engineering there. So apparently when I was there, they were teaching us using their own language. So I could not understand what they were teaching. So you can imagine all that. Chemistry taught in another language, you don't understand. So I decided, I had more time because now I could not attend the classes because of the language. So I decided, let me try something else. So there's this friend of mine who was from Kenya. We were in high school. So he was trading, he was just starting. So he introduced me to trading Forex that time. So he was still fresh, so he could not teach me anything. So I had to, look for ways. So I registered my first demo account then, and then, just placed random trades without knowing anything. And then it was exciting because of, how this thing was moving fast, the cash. I remember it was demo. So because the language was not good, I could not understand their language. I decided to come back home. So I came back to Kenya, and then the only option I had now was to, trade. So what I did was, because I could not get anyone to mentor me, my friend did not know how to trade himself. So I decided to, go online, look for every material that I could get about trading. And, funny enough, there's not much information out there, that is correct. There might be a lot of PDFs, videos, but they're too shallow or they're incorrect. And so I decided to look for, a strategy to use. Now I started with price action, like most traders, supply and demand, like any other trader would do, harmonic patterns and all that. But after studying all these things, I came to realize that almost all of them came back to one thing: wave analysis. See, because if you look at harmonic patterns, you'll realize that they're just corrections. Now, I don't want to dwell much into wave analysis already, but that's just how I started to, trade on demo. And then in 2018, around April, I opened my first live account because I met this guy in Kenya who trades using wave analysis. He trades well, at least better than what I was seeing from other people. So this guy mentored me a bit. So he guided me to open a live account on CCC. So that's when I started trading now on a live account.
All right.
So, yeah, that same year I met Razak. He called me that time. And that's how we came about to start now Cherizon Waves and started teaching people and all that. Yeah.
All right, thank you for that history. And so far, I think you have been good at trading because you have been living off of trading, I suppose. Now, can you just explain to us what wave analysis is and the 5 steps that are involved in Elliott Wave and how you apply that when you're trading Forex?
Yeah, so wave analysis, it's better taught on a chart. Because if we speak about it theoretically, then it will be hard for people to understand. So if I can share a chart and then I can explain to you what wave analysis really is.
Okay, I think we'll do that in your presentation.
And okay. So theoretically, So theoretically, wave analysis, started a long time ago by Ralph Elliott Nelson. So it's been like a century now. So he was using it to trade stock. So the theory is the market moves in 5 waves and then corrects it with another 3 waves or 5 waves. So this means that, in an uptrend, we have 5 waves. And then in a downtrend, 5 waves. But this, if I understand most of you have been trading, yeah? So you understand what I mean by trend, uptrend, downtrend, right?
Yeah.
Yeah. So if you look at the market does not move in a straight line, right? So if you have a downtrend, you'll see the market moving down and then up and then down, but the whole thing, you can see it's moving down. Now that's what a downtrend is. So the idea is the market, when it's moving down in the direction of the trend, it moves in 5 waves. If it moves against the trend, it moves in 3 waves. So that's just how it is. So unless the trend changes, that's when we have an impulse and then another impulse. So what happens is on these 5 waves, we have the first wave, which is an impulse, the second wave, which is a correction, and then third wave, impulse, fourth wave, correction, fifth wave, impulse. So this means that in case of a reversal, then we won't have another correction following wave 5. So we'll have another impulse, and then this signifies that we are reversing. Let's say if you are on a downtrend, we reverse up. So that's basically what wave analysis is.
All right, I think we will get more insights from your practical illustration, but maybe you can tell us, because there are so many strategies, where does your edge lie when it comes to using wave analysis? I mean, if everyone was applying it, maybe everyone would be making money. So how do you take that wave analysis and make money off of that strategy?
Yeah, so you understand that you can only make money when the market is moving in your direction, right?
Yeah.
If you're trading a downtrend, would you trade against the trend or along the trend? Which one would you make the most?
Along, follow the trend.
Yeah. So if you're following the trend, this means that you'll be trading the impulses, right? From my explanation of the waves. So you'll be trading the impulses. So now any other strategy like price action and the rest, you won't really know if we're starting an impulse or not, we're within a correction or not. So wave analysis gives you an edge because you know that this impulse is starting here, is ending here, because you get to count each move. So if you know that this is a correction, let's say reverses to some point. So we use Fibonacci ratios to know where the market is likely to turn and all that. So it's easy to catch the moves, the impulses. And impulses mean these heavy moves along the trend. And that's where the most money is.
All right. I think I will welcome my co-host to ask a few questions.
Okay.
All right. Thank you, Sylvia. Hello, Surjeet. Nice having you today. So I have one question, maybe to do with Elliott Wave International. They seem to be like one of the authorities behind Elliott Wave, the Elliott Wave principle. What's your take on Elliott Wave International? Did you go through it? Would you recommend being a member?
Well, I did. I actually read some of the documents that they made, the basics of Elliott Wave. And what I can say is, as much as the information is good, I think we have to, advance, because this strategy is old. So we have to look at it in terms of the new century. The market has changed a lot. So now the best approach would be, modify what they have. And that's what we've done, to make it fit the current market situations. So I think they're good, but, we need to improve. That's what we're doing.
All right, thank you for that. Then what kind of advice would you give to maybe someone who's new to Elliott Waves? Is there like a precursor before you get to Elliott Waves? For example, you've mentioned Fibonacci, you've mentioned harmonic waves. Should someone be at least familiar with that first before they get to Elliott Wave, or how would you guide someone to get into Elliott Wave?
Yeah, so Elliott Wave is a broad theory, and the best way to learn it is start with price action. Understand what candles are, understand the patterns first, it will create this foundation for wave analysis. So the only thing I'd advise you is to start with price action first. But don't base all your trades on price action. We've seen, once you understand the wave analysis, you'll see why most trades on price action are fail. So if you start with price action, you get the basis of the chart patterns, because you still apply them on wave analysis. Yeah. Okay. And then now, after that price action, then now you can start learning wave analysis theoretically. You need to read a lot. And then now practice. Yeah.
All right. So maybe my last question for now. In fact, this one is for both of you, both Razak and Surjeet. Now, when it comes to trading, a lot of people kind of say that there are algorithms that run the market. And these algorithms that are used by the major market makers, like the banks that form pretty much the liquidity, that create the liquidity in the Forex market. So they say that they usually run, or they use algos to run the market, to move the market depending on where supply and demand forces are, or where the supply and demand is. Is this the reason maybe why the market moves according to some of these mathematical principles like wave theory, or what is your take as to why the thing that you do, or the style of trading that you use, works? Why do you think it works?
Yeah, so I could go for it, Serge. No, go for it, Serge.
So the reason why we use wave analysis, like you've said, they move the market to where supply and demand zones are. So this means, you don't, there's no way you can know why someone buys or sells at a certain point, right? One person, you won't know. But if many people are buying at a certain level, then they create a pattern, right? So this pattern is well understood using wave analysis, because we now analyze them collectively. And that's how it is easy to read, to understand people will buy here. And if you've been trading for a while, you know that if you trade this pattern, let's say in price action, you trade, let's say, a triangle, everybody will set their stop losses here at the same price. And that's why you see the market spike, hitting the stops and all that. But if you're trading wave analysis, you know that this is the point where most people would be, expecting the market to turn, and this is where they'll place their trades. So collectively, all that the behavior when they're buying and selling, you collectively analyze them. Now the wave analysis gives you that ability to know where they can likely, start reversing. Yeah. So of course you won't know exactly where, but you have a better chance of getting the market where it returns or where it reverses. Yeah.
Okay. And Razak, did you have anything to add on to that?
Yeah. I'm just going to touch on it from a sort of more broad aspect. Serge's one of the traders, so he can always give you the sort of science behind it. It's like a, surgeon talking about the body, or, something like that. But I could give you a broad aspect from a sort of professional. So my background does come from working at a lot of sort of brokers here on this side in London. So I could always just give it to you more sort of conceptually. And what I would say is there's two main forms of analysis. If we just look at it black and white, all right, there's fundamental analysis and there's technical analysis. Within technical analysis, of course, lies variable different forms of analysis. But speaking very broadly and conceptually, there's technical analysis and fundamental analysis. So all technical analysis does, it believes that the market moves in historical patterns that can be repeated. No matter what form, harmonic pattern, price action, Elliott waves, whatever we talk about, we have that belief structure behind it. So when it comes to your question in terms of what's driving it, yes, it may be, algos. It could be, the major swarm of the retail market, which is, now dominating trading, and, many different factors. But we try not to look too much as to the why the market is going to move that way and who are the participants, making that movement. And we believe that Elliott Wave just gives us the broader look. So if we could see broader, and in that form, you've got your price action traders who are maybe seeing a a wave, as Sergi says, maybe a form of the impulse. From Elliott Waves, what we do is we could take that piece of information of whatever the reason is, why the price is moving in such a way, and look at it from a broader aspect to see what's next. And that's all Elliott Waves is. It gives you all of the sort of forms of technical analysis, which has that main belief structure that market moves in repetitive sequences that will be, again repeated. And as to the why, we leave that to the market. And a lot of people would, contest every movement with a fundamental that came out, or Corona, or whatever the hot topic is at the time. But us as technical analysis believers, we look at the charts, and that's going to tell us the story. So yeah, that's my answer in that regards.
All right, thank you so much. So I'd like to hand over back to Sylvia.
Yeah, so while we're still on it, before Surjeet, you do your presentation, maybe Razak, you can tell us, how do you define your risk, and what metrics do successful traders use for money management?
So in regards to how do we define our risk on a proprietary level, so the risk levels that we take to our accounts?
Yes.
Yeah. Okay, so Sergi will be best fit to answer that question. That's a trading question.
All right, so I think you can do that, Surjeet, as you do your presentation, and then as you're also waiting for the US election results, maybe you can factor in that in your live chat analysis on how you do your trading using Elliott Wave. So yeah, Surjeet, welcome to your presentation.
Thank you. Okay. I'll just share my screen.
Yes, please.
Chat. I hope you can see that clearly.
Yes, we can.
So if you look at my chart, you can see numbers, letters, trend lines, channels, arrows, and all that. So what I'm going to do is I'll take you through what they mean, and then how you can trade using these things, these numbers and all that. It may be confusing at first, but after this, you'll see that it's not really that hard. Okay.
All right.
So, yeah, this is a chart of gold against the US dollar. It's a daily chart, a daily time frame chart. So this means that each candle here represents price movement in a day. Now, if you look at this chart, let's just start from at the bottom here. So I'll just look at this section from here to the current market price. So when I started, I told you the market moves in 5 waves and 3 corrective waves. So this means that if you look at this pair, you can see the market is moving in an uptrend. And how do you know that? You can see the market making new highs and higher lows. Okay, so that's just the definition of uptrend and downtrend. Just depends on the highs the market is making and the lows. So now, in this move, gold, we started trading gold a while back. So we've been trading it from, I don't know, when it was 12 something. But I want to focus on this last move. So you can see that we have these different numbers. You can see there's the degrees. So this means that in a wave, you can have the impulses, the 5 waves. The first wave, which is an impulse, has another 5 waves. Right? So let me just draw it here, and then so that you understand the theoretical part of it. So this is what it means to have 5 waves. So let's say, okay, just a moment. Okay, so if you look at this, if this was a candlestick chart, you'd see that this is an uptrend, right? So I'll just change the color of black. Okay. Right. So Elliott Wave suggests that the market moves in 5 waves, corrected by 3 waves. So the impulses are these moves that move in the direction of the trend. So if you look at this, this would be an impulse, this would be an impulse, and this last move would also be an impulse. So now we have impulses and corrections. So an impulse moves in the direction of the trend. A correction moves against the trend. So this means that the second wave and the fourth wave are corrections. So now Elliott Wave also has fractals. This means that in every impulse, there's a similar impulse in. So what we mean by that is, if you look at wave 1, we'll have another 5 waves. So something like this. So I'll just change the color for this. Maybe blue. Okay. So every impulse here has another 5 waves. So for each impulse, you have 5 waves. And then lastly, for wave 5, we also have 5 waves. For the corrections, we have 3 waves, which is now you use the alphabets to denote them. So the alphabets for the corrections, and then numbers for the impulses. So basically, this is how the market moves. We have impulse, correction, and then another impulse. All the 5 waves complete one major impulse, which in this case, we have wave 1. So these are called degrees. So this wave 1 here is on a higher degree compared to this wave 1. So I hope you're understanding what I'm saying.
Yes.
To that point.
We're following.
Yeah. So this is the part that most people find hard, when you tell them we have 5 waves in each impulse again, because now this means that even in this wave from 0 to 1, we have another 5. Yeah. So after this big move, 5 waves, we have another correction, because now this means that this impulse is complete. So we start another correction. So this one becomes a larger degree. So we can assume it to be the first wave, 1. And then this correction becomes a larger degree, wave 2. So I hope you're understanding this.
Yeah.
Yeah. So that's how it is. And then now there are several rules that govern this. You don't just draw them how you like. So the first rule is this wave 3 here, from 2 to 3. Wave 3 cannot be the shortest of the impulses. So this means that wave 3 cannot be the shortest of both 1 and 5. So it can be short, but it cannot be shorter than both 1 and 5. Same applies to these smaller degrees. And then the other rule is wave 4 here cannot go beyond the top of this wave 1. So this wave 4, as much as it can move, let's say it become a deep correction, it can't go beyond the top of wave 1. So if it goes beyond, it becomes invalid. Now, the third rule, the last one, is this wave 2 here cannot go beyond the start of wave 1. So this means that wave 2 cannot go beyond here. And if it goes, then the setup is invalid. So now, another thing that I want to put across is every move that moves in the direction of the trend is an impulse. So in this case, we have 2 trends here. We have an uptrend and we have a downtrend. So this one here is an uptrend. But this move is a downtrend, right? So every move that moves in the direction of the trend is an impulse. So this means that even this as a correction, we have impulses. That means that the first wave, A, is an impulse that has 5 waves. wave B here moves against the trend, the downtrend. So meaning it's a correction. So we have ABC. And then wave C is an impulse. So we have 5 waves down. And this is where things get complicated. Because now, if you tell someone that this is a correction, but again, we have impulses in the correction, then they start getting confused. But I hope I have explained well for anyone to understand.
Yeah, what is the rationale behind the rules? Like, wave 4 can't be longer than, like you said, like what are the rules behind, what is the rationale behind those rules when it comes to technical analysis?
Okay, so if you look at this, you look at it in terms of how the market is playing out and how traders are trading. So if what we had before this is a downtrend, so if we have a reversal here, then this wave 2 here, wave 2 won't go beyond where the market reversed, right? Because we have a reversal from this point, because this is an impulse, and when we get another impulse, that means that the market is reversing. Now this wave 2, if it goes beyond, it goes beyond this lowest point, then it means that this trend here is still continuing. So you have to exit. If you took a position somewhere, let's say if you're buying, then if it goes beyond this point, it becomes invalid because it means this trend has not yet completed. So that's for the rule that wave 2 cannot go beyond here. And then now for wave 4, at this point, when the market is at wave 2, this is the point where traders now start to, most of them will be selling at this point still, because they think the market is still on a downtrend. So having seen that the market has not gone beyond at the start of the impulse, this means that we are now in a reversal and the market is headed up. So most traders now will start, for me, who is a wave trader, I know that from this wave 2, we're now starting to buy. This is where I start taking my position, before most traders even know that the market has reversed. Now for them, after the first move up, this is when they start seeing that the market has actually reversed, because this move mostly goes beyond the first, where wave 1 ended. And then they start buying here. So what happens when they buy here is, we know that this is the first impulse that will complete the major wave 3. So when they start buying here and the market reverses, they think they are wrong and they decide to exit at this point. After that, the market now moves aggressively up. So this means that in most cases, this wave here, wave 3, is where the market moves the longest, because this is when traders now start realizing that the market has reversed, and then now they start buying, so pushing the prices high. So if it goes to this point, wave 4 here, most traders at this point would still be optimistic that the market will continue going up. Therefore, this correction would not take long. And if it does, it won't move, below this wave 1, because how they traded here pushed prices higher. And if it goes below, then it means that the market, the traders are now no longer optimistic that the market will keep on going up. So they start, selling, and that's when the market now moves beyond. So if it does that, then it means that the traders are still eyeing at this downtrend. So this makes this move a corrective move, becoming A, B, C, meaning it corrects this move. And then now, once this wave 1 has been taken out here, we now start looking at the market in terms of a bearish move. So these are the limits that show you that If the market moves beyond this point, then it means that these traders are no longer looking at the market as moving up. They're now starting to look at it as a bearish market, and you don't want to be trading against all that. And then now wave 5 is, we have different ways of measuring it. So that's the basic of the waves. This is just the wave theory. But now there are things like how deep does wave 2 move, how deep does wave 4 move, and how far does this wave 3 move, and also wave 5. So for that, we use Fibonacci ratios to determine them. And if we get some time, then I can show you.
Yes, please show us how you apply the fibs on your waves to determine the price at which you may buy or sell.
Yeah, so these waves are related using Fibonacci ratios. So if you look at this, wave 2 here is a retracement of this move. Wave 4 is a retracement of this move, while wave 3 is an extension of this move, and then wave 5 is also an extension of wave 3. So here's how you do it. Wave 2 here normally retraces wave 1 by 61.8% fib. So for those of you who don't know how to use the tool, this is the Fibonacci retracement tool. So you start from the lowest point to where wave 1 ends. And then, so I'll just edit. We have many ratios, but the ones we'll be using will be 61.8%. For wave 2, mostly the market would retrace at around this level. So it's not guaranteed that it will retrace exactly 61.8, but in most cases it does. So this is the point that you start looking to buy for wave 3. Now, wave 3 here extends wave 1 by 161.8%. So to measure wave 3, you start from the top of wave 1 back to the start of the move. And then the ratio you're looking for is 161.8. So 1.618. So in percentage, 161.8. So this point. So this is the point where wave 3 mostly ends. And that's where you'll be targeting when you're trading wave 3. So wave 3 in most cases extends. It can go beyond 161.8. So if it does, the next target would be now at these other levels here that are beyond 161.8. But in most cases, it won't go beyond this 3. But the first target you set is 161.8 for wave 3. So I hope up to that point, it's clear.
Yeah, and then maybe Surjeet, before we go to the Q&A section, maybe you can show us application of your money management rules in also when you're doing the wave analysis.
Yeah, I'll show them here, right here.
Okay.
Because now for money management, I think the only thing that separates Forex trading from gambling is the ability that we can manage our risk, right? So how do you manage your risk as a trader? So there are a few ways of managing a risk. One is using your stop loss. So how do you use your stop loss? So most people, when they're starting trading, they're taught that you set your stop loss at, let's say, 10 pips, 20 pips, specifically how many pips. But for me and other wave analysts and our students, we understand that if we set our stop loss, let's say if you're trading wave 3 here, and we set our stop loss at 10 pips, should be somewhere here. If the market continues moving down, so let's say wave 2 here continues moving down, but does not go beyond the start. So if let's say you took your trade, okay, just a moment. If you took your trade somewhere here, and then you set your stop loss at 10 pips, which is roughly here. Your stop loss would be taken out here, but wave 2 is still valid because it has not gone beyond the start of the wave 1. Now the market reverses without you. So what you do to set your stop loss, if you're trading using wave analysis, you set your stop loss at invalidation levels. So this is the right way to set your stops, because the stop loss simply means a place you set, the level you set for that position, where if the market hits, it means you're wrong. Not if it hits, this is the amount I'm losing. It should be, if it hits here, then it means I'm wrong and I should get out of this trade. So if you set for 10 pips, that doesn't really mean that if it goes for that 10 pips, you're wrong. Maybe the pullback was just deep. So what you do is you set it at where if the market hits, then you're wrong. So in this case, for us, if you're trading wave 3, if the market goes beyond the start of wave 1, then it means we are wrong, and that's where we exit our position. So if we are trading after wave 4, then we know that wave 4 here cannot go beyond wave 1. And if it does, then it means we are wrong. And that's when we exit the market. So when you're trading this wave 5, because we only trade impulses, and the impulses we trade is just wave 3 and 5. Because when this is starting, you're not yet sure. So we trade this because this is almost, high probability. Wave 5 is also a high probability setup. So if you're trading wave 5 and the rule is wave 4 cannot go beyond wave 1 here, then it means that if you set your stop loss here and the market hits it, then the setup is invalidated. So you exit because you're wrong. So that's what I would advise traders to do. Set your stop loss where if the market hits, then it means you're wrong, not just you're willing to lose a certain amount of money, a certain amount of pips. So set it at the invalidation level.
Thank you for that trading insight. So I think now I welcome Gilbert to take some questions from the audience. I think Razak will help you with answering the Q&A.
Okay.
All right, thank you so much, Surjeet, for that wonderful presentation. So there are a few questions coming in, but before maybe I get to the participants, maybe one question again to elaborate on the issue for risk management. Do you normally advise, because you're exiting at invalidation levels, and those invalidation levels, you can be able to tell how many pips that would be. Do you usually have some kind of like an equity-based stop loss, like saying maybe based off of where I expect this trade to be invalidated, it's going to be maybe about 1% or 2% of my capital? Do you do something like that, or would you advise on that?
Yeah, I would advise on that, because now you don't want to lose your entire account on one trade. So let's say if you're confident about what you're doing, then at least if you're risking maybe 5%, it makes sense. But to me, I think no matter how much you advise people on how to manage their risk, it will always depend on them, because the account is theirs. So if they want to risk high, then it's entirely their own. But to me, if you want to be long term, then you have to have a very clear risk management, because analysis is one, trading is another. So if you can analyze the market well and not manage your risk, then you'll be out of the market in no time. So the best way to do that is you can use the tool available on my FX book to calculate the lot size. So let's say you're risking 5%, then there's that tool to calculate the risk. So it's really helpful to risk a certain percent, depending on how many pips you're risking.
Yeah, just to add on there, I completely get what Sergio's saying. Again, not being a trader, but of course having a lot of deep insight as to what the guys at Cherizon do. As he mentions, we're trading wave 3 and wave 5, and even if you don't know about Elliott Waves, we simply look at the charts. You can see that these are some of the sort of biggest movements. And as he mentioned, just by pure logic, if we're looking for the biggest movement and we're only going to set our stop loss at sort of, invalidation level, then therefore the sort of risk that we're gaining is going to be a lot more than what we're willing to lose. So in that respect, it's going to be subjective to every individual trader. If you're trading a mini lot, it's going to be completely different numbers than if you're trading 2-3 standard lots. But in regards to the direction and the risk to reward ratio, it would be the same. So yeah, just adding if that helps in that regards.
All right, thank you. So before I request you to unshare your screen so that you can go properly into the Q&A section, there is a question here to do with the Fibonacci extension tool that you had used to project that level, the extension level 161.8, 1.618. And there's Leon who is asking, can someone use the trend-based Fibonacci extension, or could you please repeat how you came up with that projection of 1.618?
So most of these are just based on the theory and the principles that was set by Ralph Elliott, and we've since seen that they work. So what he's asking is using this other tool called trend-based Fib extension. So this tool here, you use it for corrections. So for example, this part, like I said, it's a corrective move. So to use this, you need 3 points. So the first point is the start of that correction. So point 1, all the way to the end of A, and then back to wave B. So like I said, there are many rules. So for corrections, there are many rules, and there are many types of corrections, not just this. This is as simple as zigzag. There's a zigzag, we have a regular flat, we have triangles. So there's still a lot to learn. That's why I said that reading is the key thing. So in this case, let's say it's a zigzag and wave A is equal to wave C. Then using the trend-based Fib extension, you can see that this level is where wave A becomes equal to wave C. So this is how you use it. You need 3 points to use the tool.
Okay, thank you. So maybe if you could unshare your screen so that the audience can be able to see you better as you respond to their questions. Is that okay?
Okay.
All right. So there's someone who's asking, does Elliott Wave Analysis have an edge in all markets? If not, what markets are best fit to trade?
Okay, so I'll respond to that. So first of all, when Elliott Wave was brought to light by Ralph Elliott, he was not trading the Forex market. He was trading the stocks. So that means it was working for him there. And now it's working for us on the Forex market. So this means that you can use it in any market, in any time frame as well. And just to add on that, if you look at these pairs, we have a lot of pairs, but you don't just trade all of them, right? So if you look at what we trade, we only trade the major pairs and gold, mostly. And why do we do that? These pairs move 85% of the time. And you can't make money when the market is stagnant. So you look at pairs that move, and these are major pairs are the pairs that move. So focus on them. Plus, you can't have like 10 positions on 10 different pairs. Focus on few pairs, like how we do it, the 8 pairs. That's when you can make the most
out of it. Could you please give some samples of or examples of the major pairs that you like trading using Elliott Wave?
So we trade Euro USD, we trade USD, Swiss franc, USD, Japanese yen. Okay, all pairs which are USD on the major pairs, NZD USD, Audi USD, gold.
All the majors, essentially, all the major Forex pairs and gold.
Yeah, that's like trading 101. Every trader knows the major pairs.
Yeah, so I know that, but I just wanted to have that clarified for the audience. Yeah, because some brokers list some cross currencies as major pairs, like Euro yen, Pound yen. They would kind of come in their section as major pairs. So I just wanted to clarify that, whether they're dollar pairs or maybe you trade some currencies. Okay.
Just one thing to add on my side, as the question resumed. Again, it's quite good because the viewpoint I speak from, I'm not sort of a trader at first hand, so I look at this very sort of objectively. And Surjeet just gave a very extensive presentation, touching on some things that to really comprehend would take you, as he said, some hours, some time, and some deep sacrifice or commitment to learning. But what I really do like about Elliott Waves is once you understand just that basic illustration which he gave just now. So for those, as you mentioned, this will be recorded. So if you go back and just really understand that presentation, I promise you, go back to the trading charts and you will see the waves. And then you will understand that anyone that's trading, they might be trading one fraction of the wave or the other, and it might be governed by one set of laws or the other. But the first thing is really, before you know where the waves are going, to identify the waves. And that's what Elliott Waves and that perfect illustration that he just gave very extensively will give you the ability to do. So some of the questions that you guys might ask, don't be outstanded if, you don't understand. It will take time. But yeah, that basic illustration would give you a good all-around understanding.
All right, thank you. There is someone called Kelvin who is asking, if the setup is invalidated, can we use the new wave as the start of a new cycle? So for example, like when you're looking at the invalidation levels, or do you just end the trade there and move on to another chart?
So once your trade is invalidated, it means you're wrong. And if you're wrong, you don't just, after you exit that sale, you don't just directly buy because you're wrong. Go back, check. Maybe the trade you're taking was, maybe you're buying, but the correction was not over. So go back and check before you enter that next trade. Because of course, these waves, you'll see them in the market and you'll know when you're wrong. Yeah.
Okay, thank you. There is Noel who is asking, is that Noel? Yes, Noel, could you practically apply it and explain on the gold chart? So that's what you've already done.
That would take us back.
Okay. So I think that one we had already done. There is another question by Michael. At what Fibonacci retracement level does wave 3 retrace to? So in that case, yes.
Yeah, wave 3 does not retrace, it's an extension. Retracements are for corrections. So wave 3 extends wave 1 by 1.61. Yeah.
Yes, so maybe this might have been probably wave 4. Wave 4, is there a particular Fibonacci retracement level?
Okay, so that's 38.2%. It can go as deep as 50% or 61.8%. The rule is it does not go beyond the top of wave 1. But in most cases, it retraces at around 38.2%. Wave 4.
All right, thank you so much. There was just one last question here. Though I believe you had mentioned that you can use Elliott Wave principle on basically every time frame or any time frame. But what would the best time frame be, especially for new traders?
Yeah, so many traders, they don't even understand what time frame is. Because to me, you can just pick a chart and then say, I'll be trading 5 minutes time frame forever. No, what you do is you start analyzing from the monthly time frame. You should know where the market is headed on the month. You should know where the market is headed on the weekly, on the daily. So you break it down like that. So that means that if you're using wave analysis as your strategy, then you'll start from the monthly, analyzing it, and then go down to the weekly, go down to the daily. So this means that you've used wave analysis from the monthly all the way to the smallest time frame. But I would advise you not to go below 15 minutes time frame because it gets noisy and you'll start losing focus.
Yes. And I think that also ties into someone who had asked about identifying the trend, like how do you normally identify your trend so that you can start looking at maybe getting in on the retracement of after wave 1, so during the retracement of wave 2. Is there like how you've broken it down, maybe monthly chart? Is it okay if you can give us maybe just a brief illustration on your chart, like how you normally break it down, like how you would identify your trend? If that's okay.
So I'll share a chart again. Yeah, so I won't go back to analyzing from scratch because analysis really takes a long time.
Yes.
So I'll just show you because on my charts, I don't really delete the analysis from the time frames, from the big time frames all the way. So if you look at this, so this part will be messy because we have a lot of information there, but I think we can see from this point. So from 207, we can see the market was moving up, and then we had a move against the trend, and then we started another move up. So this is, you can start your analysis from this point, basing that this move here is a new impulse, and in any impulse we have 5 waves. So starting from this point, we have the first move, and if you see this is a monthly time frame. So I started analyzing this pair on a monthly time frame. If I break it down to the weekly, then I should be able to see that this move was indeed an uptrend, wave 1, and then this move, you see, this move here went against this trend, the new trend, making it a correction. And you know, the easiest way to do this thing is once you open any chart, just look at it plainly. Let's take this example here. Any move that goes against the trend, just mark it out. Any move that should be major. So any move that moves against the trend, like this whole move here, that's how you start it. So on a plain chart, just mark out these moves that went against the trend, and all those moves would be your corrections. So it makes it easy for you to analyze on any time frame. Because I don't want to go much into this because you know waves take a long time to analyze. Let's say we can analyze the monthly another 20 minutes, go down to weekly another 20. Yeah.
All right, I think that's okay. And I believe that that question has been answered. You've answered that question conclusively. There are some questions here maybe I can answer. There's George who's asking whether we have the Elliott Wave indicator on the MT5 platform. And to answer your question is, you can get these indicators and install them on MT5. So they may not be stock, that it comes directly with the MT5, but you can go to certain websites like MQL5, and you can be able to download that indicator and install it. So
yeah,
that
but just to add on that, most traders would think that these are indicators. They're not. Actually, on my chart, there's no indicator, not even one.
Yes.
So I don't use indicators to trade. Yeah. So all these things are just purely technical, no indicators. Yeah.
Okay, and maybe for the last question by Noel, he's asking how can people sign up for your classes if you offer any on this wave analysis?
Yeah, so I'll leave that to Razak to answer that.
Okay.
So yeah, again, just going back into it. So what we do here at Cherizon Waves is we're a technical analysis and an education firm. So the technical analysis from that aspect, if you are trading or you do have, a live account that you are looking to grow, we provide, many sort of services which, allow you to receive Surjeet's well-crafted analysis in different time frames, swing trading, intraday, and that's on the signal side. So you could just come to us at Trading Waves, and there's more information on that. And intertwined in that, on the education side, we have an online mentorship, or digitalized, consisting of a series of videos, tutorials, PDFs, all crafted by us here in the team, and most importantly, Surjeet, which illustrates all of the laws, teachings, and information included thereof.
All right, thank you, Razak. Maybe you can unshare the screen so that we can maybe go through the last section. I'd like to hand over back to Sylvia. Thank you so much, Surjeet and Razak, for that wonderful presentation.
Thank you for having us.
All right. I think we have learned quite a great deal on Elliott Waves, and the last question would be to Surjeet, who's your go-to trading idol and why?
So I just have one. His name is Robert Balan. He's a genius.
We've never heard of him. Maybe you can point us to how we can maybe read up on him or
So
understand.
the thing about most of us is we like, being undercover. Yeah. So it's hard to find him, but I did. When you study broadly, you find the right people. They say in the Chinese, when the student is ready, the teacher appears. So that's what happened. So now I think I teach what he teaches because I learned what he taught. So
All right.
it's pretty hard to find. Yeah.
Are there any books on Elliott Waves that people can start with? Like you said, you have to be well read for you to use the wave analysis. So which books would you recommend on that? And maybe Razak, you can tell us how to access the Cherizon Waves website and registrations for your classes, and if you're active on social media, what platforms people can use.
Yeah. So I'll just answer the latter. So in regards to finding us, we're available on www.cherizonwaves.com. And we also, big on all social channels. So Facebook, Instagram, LinkedIn, mainly under Cherizon Waves. You and I will have a talk later, Sylvia, but just based on the discussion, I'm thinking of maybe having a little discount available for all the students available at this webinar, so they can learn more because they've taken the commitment already, coming today and listen to us and how we could tailor a nice deal with them hosted by you.
All right, I think we can link those links on the show notes when we're uploading this webinar, and then they can get in touch with your contact details. Yeah, so any parting shot from Razak and Surjeet as we conclude? Your last words for 2020?
Yeah, it's been a crazy year. We don't even want to speak too soon because we know how that goes. In regards to now, I'm just going to enjoy watching the markets because it's an absolute spectacle, and it's amazing to be part of, or to be able to witness such history, let alone and how that's affecting the markets. So definitely sitting here tight under lockdown, unfortunately, but with a close eye on global affairs.
Yeah, I really appreciate this platform. And my last thing to every trader is, don't give up. It's going to be hard sometimes, but the best way to do it is get yourself a mentor, a right mentor, someone who is trading. Because some people don't trade, but they can mentor you. So, yeah.
Oh, thank you. That's practical and truth. So thank you for that real dosage of truth in our industry. We thank you all for your time, and we would love to have you again in the future if your time allows. And we appreciate your time. Thank you also for guys to joining in. You can start off by opening a live trading account with Scope Market, so you can apply wave analysis as we've been taught by Surjeet and Razak. So until next time, goodbye, stay safe, and thank you. It was a good time.
Thank you for having us. Thank you for everyone who participated and watched. Have a good one. Take care.
All right, take care, guys.
Bye.
Bye.
Remember, you can open a live trading account with Scope Markets and apply the lessons shared by the guest in this webinar to your trading. Many thanks to our guests for speaking to us. We'll be open to have you in the future. Till next time, goodbye.